possibility of sort of cascading risk coming off this is certainly there, and we've seen that in the past. My sense is, though, that the tide is still coming in. What happens when the tide starts going out? Is this whole process going to accelerate?
Well, I think you're right to focus on the sort of macro story. There's still an enormous amount of monetary and fiscal stimulus in the system, and more coming, apparently, and if the infrastructure bill ultimately passes. And so that's providing, a real cushion of liquidity under these markets. So I'm not sure the tide's going out anytime soon. It feels to me, Scott, who I just heard say that there are probably more of these events out there, but thus far, even this, which was the Archegos, was very serious and it was large, but I don't think represented a risk to financial stability.
Mm-hmm. Well, and part of that, Jim, is because regulators have done a really good job of shaping up the banking system to not have these risks. What do you think regulators are going to do about this?
Well, I think it's the FSOC, the College of Regulators, that was formed under Dodd-Frank, is clearly going to have to take another look at the prime brokerage business and the kinds of leverage that's being extended, both through the derivatives markets and directly. Regulation T, which applies to the ordinary investor, margin loan says you can't borrow more than half the value of the security. And lever your position up that way. Clearly, family offices, hedge funds, other institutional investor clients of the prime brokerage business have been able to obtain much more significant leverage against financial assets than the ordinary investor. And so, obviously, there are risks associated with it. Particularly in an individual name, which proves to be highly volatile as a result of events, endogenous to its own corporate life. When you're highly levered against individual names and not terribly diversified, you do run a significant risk of in effect a margin call, and the lender runs a risk that it can't liquidate its collateral position or cover its derivative exposures quickly enough to avoid a loss.
Jim, there's another area I want to point you to too, because you have the CFPB on the other hand pointing to a tidal wave of distress among homeowners. Do you think that regulators in the Biden administration are right to be looking at mortgages as an area that could become a problem as we look to more evictions ahead?
Well, currently, about 6% of all outstanding mortgages, which is about $600 billion of mortgages, are in some stage of delinquency or default, and another 5%, or half a trillion, are in forbearance. Those forbearance programs currently extend into. You're going to continue to apply through June of this year, and those are generally 18-month forbearance periods. So. Through the forbearance programs, you've extended out the period where loans might otherwise go into default. But what that means is you've got 4 or 5 million homeowners who are either in forbearance or in some stage of delinquency. And so, that's not surprising. You have still 9 million people unemployed, 18 million people on some form of public assistance.
Jim, isn't that the point, though? We just had a print Friday that was nearly 1 million. We've just seen a JOLTS number that is well ahead of expectations. The ISM number yesterday, the service sector is coming back. The purpose of the programs that were put in place by the government was to provide a bridge to the labour market recovering. How many of these people that are on the edge in terms of the housing market are going to be pulled back from it by a jobs recovery?
One could hope everyone. We're in the early stages of the impact of all of this fiscal stimulus on the jobs economy. And but it's, you cannot discount how significant this stimulus programs have been. And, my guess is that as we increase our vaccination rates and infections go down and the economy opens up, the most adversely impacted sectors, where a lot of this employment is, potential employment is to come back, will come back. In the travel and entertainment and retail and restaurant sectors, we should see a very strong recovery, in the third or fourth quarter.
Jim, you had been talking for a year about taxes. We're here, right? So how do you expect folks to be reacting to the prospect of higher income taxes and higher corporate taxes? And what do you think of Yellen's plan for the global corporate tax?
Well, there is the risk, and I think we've seen this around the world economy, of a sort of race to the bottom on corporate taxes. And so I think the Secretary's impulse here to deal with sort of minimum corporate tax levels so as to avoid, inversions and the like, where corporations are shopping for the lowest tax jurisdiction in the areas in which they actually operate, is an important initiative. I think we need to do that with the other OECD countries. But listen, as I've said before, over the last 40 years, really since President Reagan, we have continuously lowered the corporate tax rate, and we've continuously lowered personal income tax rates to the point where, we're running now a structural deficit of something like $2 trillion on a base budget of $4.5 trillion. So, it's a pretty significant deficit now, and we have starved. I mean, this has been sort of the strategy, frankly, of the Republican Party, has been to starve the federal government of tax revenue. And we're now at a point where, as a result of this pandemic, which no one could have predicted, at least the manner in which we fumbled the ball and created a significant economic problem for ourselves, the pandemic has clearly exacerbated the deficit problems because we've had to spend so much money to address the real needs that the shutdowns created and the health crisis created.
So, Jim, what number makes a difference? So the talk is, 28%. Senator Joe Manchin said non-starter, looking at 25. Is 25% corporate tax rate really going to make a difference?
Well, let's put it in perspective. Corporate profits that are an all-time high, remarkably. About $2.5 trillion in the United States is the aggregate corporate profit. The corporation sector is going to pay less than 10%. And that's their effective tax rate, given all of the shelters and deductions and credits that are available to the corporate sector. So the corporate sector, the bulk of the federal budget is paid for by individuals. 86% is the personal income tax and Social Security taxes. The corporate sector is paying 7% of the federal budget today, which is the lowest percentage of GDP in 50 years in terms of corporate tax rate. So, I think it's both the rate, which is, just a starting point in the corporate tax code. But do corporations have to pay more? We could say only individuals pay and raise capital gains tax rates and capture profits to, business owners, whether through LLCs or corporate form. But if we are going to have a corporate tax, the corporations are contributing to the government from which they benefit. Then, talking about rate 21, 25, 28, that's just a starting point. You really got to focus on the effective tax rate, which is clearly much lower here in the United States. We are one of the most favorable jurisdictions to operate as a corporation.
Jim, what should be the effective tax rate in the United States? Give me a number.
Well, if I were designing this all, I'd have a very simplified tax code, both for individuals and for corporations, and have a flat tax. We have used the tax code for social engineering and for economic policy for, really since the beginning. And the question is, should we be using the tax code as a form of economic engineering, which is not terribly transparent to the public. Or should we actually, if we're going to actually subsidize, given particular industries, shouldn't that be transparent? Shouldn't we have a real policy debate so the public knows which industries are being benefited and which are not? Because this is very arcane stuff. So I would say if corporate profits are $2.5 trillion, give or take, should 20% of that be coming into the federal coffers to pay for all of the things we do for economic growth and business development, from education to infrastructure? Yeah, I think so.
So Jim, we have time for one more question here. I want to know what your clients are saying, right? We are still at serious highs in the market. There are bubble worries all over the place. What's the one worry still out there?
I think you just said it, Sonali. I mean, I think with the S&P trading at 24 times earnings, that's predicting an awful lot of growth in this economy. And as the stimulus wears off and the Fed eventually withdraws the extraordinary monetary support they've provided to these markets, the question is the growth going to be there? That's the hope. That you've got to assume all of this stimulus is trying to push the business sector forward and create momentum for jobs and profits and growth. But it will wear off eventually, because we will eventually have to deal with these deficits, which are extraordinary in U.S. history.